most people don't understand this. The Fed certainly doesn't seem to understand it. So we do not think the greater risk here is inflation. Commodity prices are the first place you'll see inflation brewing. And commodity prices are determined at the margin. So incremental demand relative to supply, which shot commodity prices up during the COVID crisis. And we had not only COVID, but the war in Ukraine exacerbating that supply shock. Now you have them coming down, and we don't know what's going to stop them from coming down further now, perhaps to the lower end of this range. Hopefully not lower, because that will be we'll be in more of a free fall situation, which of course we do not want.
Surging mortgage rates and still high home prices are not leaving already demoralized home shoppers much to be thankful for these days. Indeed, the national average 30-year mortgage rate lost a tiny bit of steam the first week of November, but not before rates had already catapulted to a 23-year high of 7.79% by the end of October, according to Freddie Mac. The 30-year fixed rate eased by 3 basis points to 7.76% in the week ending November 2, the first bit of relief following 7 consecutive weeks of increases. A basis point is 1/100th of 1 percentage point. For some context, mortgage rates were in the low 3% range only 2 years ago. In the face of high home prices and rates, monthly existing home sales sagged for the 4th consecutive month. Sales dropped by 2% in September compared to 0.7% the previous month, with all 4 major U.S. regions posting declines, according to the National Association of Realtors, NAR. Cathie Wood shares her view on the market condition, pointing at the downtrend of the housing market and its correlation to the period of financial crisis. Let us now get into the video. Don't forget to like, subscribe, and drop your comments below.
Housing affordability has been destroyed with the interest rate hikes that we've seen over the last year and a half. And you can see that in this chart, the National Association of Realtors Housing Affordability Index. In fact, I think you have to go back to the early 80s, late 70s to see affordability ratios as low as we are seeing them now. And of course, housing, by some measures, sales are down 40%. Here's existing home sales. And you can see we are below where we were during COVID, when the economy just screeched to a halt. And we are in the same territory where we were in 08-09, when we were going through the biggest financial crisis of our lives. So that just gives you a sense of how depressed the housing market is. And people are just not going to move because they have 2.5–3% mortgage rates, and they don't want to roll over into 7.5–8% mortgage rates or higher. So trapped, I think, is a good word for that. Another very cyclical sector, the auto sector. You can see it's a mature sector. It doesn't get much above 17.5, 18 million units. Hasn't since 85, except on rare occasions. And yet you can see from this chart that we never got back there. And sales at roughly 15.5 million units are very slow by historical standards. And we think they're going to start falling again. This is a big ticket item. Unemployment, we believe, is going up. Students are now having to repay those loans after a 2-year plus moratorium. And so this kind of big ticket is going to suffer, we believe. And so that will contribute to the recession we see ahead. Again, this has been part of a rolling recession. It's been on its way down for a while. And I'm going to present now 3 charts from our friends at ISI Evercore. They do surveys of economic activity every week. And one of the things you've heard me say on In the Know is that we are watching our companies report and listening to these earnings calls. And companies are basically saying, it's getting really bad out there. But we weren't seeing the same thing from economic statistics. And we were puzzled why markets would pay attention to macro indicators when companies themselves are saying, something is not right out there. Now, you will hear the way that the financial news broadcasts talk about earnings. They'll say, oh, revenues beat expectations, earnings beat expectations, but those expectations have been pulled down all quarter. Revenue and earnings are weak. And I think according to our analysis, and this is pretty fresh, about 30% of all companies in the S&P 500 have reported revenue growth that is negative on a year-over-year basis. You don't see that in the macro statistics. But more and more companies are reporting that revenues are falling on a year-over-year basis. That is a recession indicator if there are ever one.
Top global banking chiefs on Tuesday said they are concerned the financial sector's next crisis may come from rising geopolitical uncertainty, which could test financial market resiliency, while the industry remains vulnerable to regulatory tightening. The trigger for the next global financial crisis is likely to come from the geopolitical or political space, said Morgan Stanley chairman and CEO James Gorman. Gorman was among more than a dozen top executives of international firms speaking at the Global Financial Leaders Investment Summit hosted by the Hong Kong Monetary Authority. The challenges to democracy in some countries around the world are pretty evident, Gorman said without elaborating. The comments come as an unfolding Israel-Gaza conflict adds uncertainty to the global economic outlook, while the Russia-Ukraine war drags on and Sino-US tension simmers despite efforts to bring leaders of the two superpowers closer.
Sometimes you have to step back from the day-to-day and gain perspective to understand where you are, and in the case of commodity prices, where they are. So this is indexed to 100, which I think was a 1980 number. And look where we are. We're back where we were in the early 80s. Commodity prices have gone nowhere. And if you want to look at recent times, sure, you can see the supply chain shock that we went through that took this metric up from roughly 60, roughly doubling it, 60 to more than 120. But it's coming down now. It's down more than 25% from its recent peak. And if you look at it again, perspective is everything, since the 08-09 crisis, you'll see that it is in a downtrend. Deflation. Most people don't understand this. The Fed certainly doesn't seem to understand it. So we do not think the greater risk here is inflation. Commodity prices are the first place you'll see inflation brewing. And commodity prices are determined at the margin. So incremental demand relative to supply, which shot commodity prices up during the COVID crisis. And we had not only COVID, but the war in Ukraine exacerbating that supply shock. Now you have them coming down, and we don't know what's going to stop them from coming down further now, perhaps to the lower end of this range. Hopefully not lower, because that will mean we'll be in more of a free fall situation, which of course we do not want. Here's the picture of non-farm unit labor costs. The bears would have had you believe that this move up starting in 2010, unit labor costs were negative back then. Compensation growth was held down during 08-09, and productivity actually increased. So unit labor costs were going down. They crossed over zero in mid-2015 and had been going up. And many people thought, okay, COVID let the genie out of the bottle. And we did see unit labor costs go up as labor was so difficult to get. But just look at it now, down to 1.8% on a year-over-year basis. So unit labor costs takes compensation, both compensation and productivity, into account. So it's output per man hour, that's productivity, and unit labor costs are compensation costs less productivity growth. So we're at 1.8%. That's below this 2% inflation target. And the Fed has been very worried about the labor market causing inflation. This chart, this evidence would suggest that has not happened. It is not like it was during the 70s. Look what happened. We got into the double-digit range here, where we've just reversed. And I think this was an important indicator for the Fed this week. And I think they're a little bit more on high alert that they may be making a mistake here. They won't say that their vote this week was unanimous to hold for higher and pay attention to the data.
They say that history tends to repeat itself. What's happening in the housing market right now? Except it's worse than the disastrous crash of 2008 in some ways, according to a Goldman Sachs analysis. Mortgage rates are at their highest levels in more than 2 decades at nearly 7.5%, and home prices continue to creep upward because of decades of underbuilding and the resultant lack of houses. For the second quarter of 2023, the average sale price in the U.S. hit nearly $500,000. According to the Census Bureau, nearly double the price of homes at the time that the housing bubble burst in 2008. The Wall Street Bank is far from alone in its withering assessment of housing costs. The Atlanta Fed found that housing affordability has deteriorated beyond 2006 levels in its Home Ownership Affordability Monitor, which tracks factors including median home prices, median income, mortgage rate, monthly principal and interest payments, and the average percentage of income spent on mortgages. As of July 2023, housing affordability had dropped nearly 8 percentage points year over year and remains more than 31 percentage points below the threshold considered widely accessible. Although there's still reason to be concerned about housing affordability, a lot has changed since 2008 when Fannie Mae and Freddie Mac were placed under conservatorship by the U.S. government. And the major challenges facing the housing market today differ from before. For 2 decades ago, products like zero down payment mortgages and taking out cash from a home's equity helped more Americans buy property, boosting real estate prices at the time of the last crisis. Today, prices are high because there are much fewer homes for sale. Indeed, housing inventory levels are near historic lows. Between September 2018 and September 2023, the average number of homes on the market dropped a whopping 60% to below 700,000 active listings, according to Realtor.com. Today, we're seeing mortgage rates and home prices climb in tandem, a brutal storm for would-be home buyers who find themselves priced out. During the last crash, higher loan payments started to translate into weaker home prices, which isn't the case today. What do you make out of the analysis by Cathie Wood? Let me know your thoughts in the comment section below. Also, don't forget to give us a like, subscribe, and turn on notifications. Thanks for watching.